Welcome back. Earlier this month, CNBC's Hugh Son reporting that Goldman Sachs planning to cut up to 8% of its employees in January. This morning, CEO David Solomon warning mass layoffs would indeed be coming. Let's now bring in CNBC.com banking reporter Hugh Son. Hugh, put it into context for us here. I mean, obviously, these firms, they have an annual process of culling some people. There's obviously with Goldman Sachs, maybe retrenching a little bit on the consumer finance side. So how does this current layoff push fit into all that?
It's a terrible way to start the year if you're working at Goldman Sachs. There's a lot of anxiety. There's a lot of concern behind the scenes. So just to reiterate, we talked about an 8% cull, which is a bit outsized compared to the typical 1 to 5%. And that's going to happen in the first half of January. That was really the one tidbit of news in the voice memo that Goldman CEO David Solomon sent out to his staffers earlier. And so it was really seen as like, okay, this broke in the press last week earlier than they would have liked it. And so let's at least tell our staffers, our 80,000 or so employees, what to expect. And what to expect is a cut, of up to 4,000 people in the first 2 weeks of January. And that is really going to focus on people they consider underperformers, people who in the past would have been culled already, but they had 2 years of a pause to these kinds of layoffs, or people who are involved in the consumer operations in which they're retrenching. And that's a very specific Goldman story.
So there's the very specific Goldman story. There are the job cuts. Then there's also the reports that you're going to have big banks kind of across the sector slashing bonuses, as we've seen the dearth of deals this year as well. I guess just walk me through, in general, what the beginning of next year is going to look like for financial services employees.
Well, I'll walk you through the bull case, which is if you're at Goldman Sachs and you're the head of equity capital markets or debt capital markets. Right now, you're in the process of saying, well, look, David, I understand, we've had a terrible year. Do you think 23 is going to be as bad as 22? And their pitch is, once we get certainty on the glide path of interest rates, there's going to be more activity now. There's going to be some more IPOs than there were in 22. There's going to be more deals than there were in 22. That's the bull case. And that's what you're saying. You're talking your book if you're at Goldman Sachs and saying, don't cut as many as 8%, cut a smaller amount. The bear case is, we're headed into an economic downturn. If the S&P is down 10, 15, 20%, that's not a great market to be going public. This continued crunch of companies that were in the pipe but that have yet to go public is just going to continue until perhaps the second half of next year. If that happens, then you'll see more banks decide to say, let's cut back on our human infrastructure a little bit. We're overstaffed for the current environment, and so let's continue to cut. And I think there's possible that you will see other banks follow Goldman in the first half of next year.